we have a lot of clients, I have a lot of customers that ask me that, or that may feel that they may have been declined by in the past and are not clear what direction to go in as far as obtaining a mortgage loan. And this has really gotten to be a big issue in the past few years, as everybody's all heard in kind of in the media about the tightening of credit standards in the mortgage loan industry and those things. And it is, and it can be a little bit daunting and it can be a little bit threatening. But I think when you understand the process, it gives you some really clear things that you can look at. And if you have been, declined in the past or something, that's not necessarily, doesn't mean that there isn't something that can be done. And I have an acronym that I like to use, and I call it STEP. And basically what it means is you have to have a satisfactory credit score, you have to have the total investment or the down payment, you have to have employment, and you have to have payment affordability, meaning that you can qualify debt ratio wise for the payment. And that's the step to owning the home. And we have a lot of customers, or many customers in many circumstances, will have 3 of the 4. And that's what I always tell people. If you can look at it and you have 3 of the 4, then you have a very, very workable situation. The first factor in the STEP, as I like to call it, the STEP process to obtaining a mortgage, is having a satisfactory credit score. And there are many circumstances today that I think people will look at their credit score and they're a little bit intimidated by it because they don't really know what it comes from and where it's derived. So I'd like to talk a little bit about that and hopefully be able to shed some light on it. Your credit score is simply a mathematical algorithm. It is a formula, just as in an algebraic formula. So meaning that there are numbers that are put in and values put in, and there's a score that comes out the other side. So, I think a lot of people tend to mystify it, and they say, I hope it gets better, or gee, we'll check it out later and maybe it'll be better, as if there is some kind of credit deity that's going to bless them or not bless them. And it's really not that way. It is a pretty simple, straightforward process. And when positive things are put in, positive things come out. Now, one of the things that we found, and one of the really neat tools that we have available to us and that we offer to you at no charge, we have a service that's called Credit Expert. And the credit score model is based on a model called Fair Isaac, typically, depending on the credit inquirer, but all the models operate in the same way. And what our credit expert does is it uses the same model and it does what if scenarios, meaning it will tell you the actions that you can take specifically to raise your score, and it'll give you a numerical point value of how much it'll raise your score. And this is not what if, maybe, we hope. This is guaranteed. It works. If you do these things, you will get this result. And it takes a lot of the question and the guessing out of it. And we've had several circumstances where we'll have clients that come in and they'll do things simply as opening, because they don't have any revolving credit accounts. They'll open a credit card account, their credit score goes up 60 points. Or it may tell them to pay a loan balance down to a lower balance ratio, and their score goes up 60 points. So there are just numerous people out there that really can qualify for a new home that don't know they can or don't think they can. So we like to help those people and open the opportunity to them and show them what we can do. So give us an opportunity. One of the other interesting facets that I'd like to talk about as far as the credit score too, that I don't think a lot of people understand, and this is a fascinating thing to me. As I was saying briefly or a minute ago about the credit scores being mathematical equations, a lot of people don't understand the relationship of balances to debt, to total debt. And I'll give you an example. You can have a $300 credit card with a $300 maximum credit limit, and you can have it charged to $290. That is the same thing in regard to the way that the credit bureau calculates your credit score, is to having a $30,000 credit card with a balance of $29,000. It's just 2 more zeros. But the way that the credit model works, it looks at debt as in a percentage of the available debt. So a lot of times people will think they'll have they'll have installment debt or revolving debt that is relatively small, a $1,000 credit card or $1,500 loan, but yet it has a high balance into relation to that debt, but they think, oh, that's only $1,000. But the credit bureau doesn't look at it that way. It looks at it as a percentage as to what the debt originated as or what the credit limit is. So there's a lot of times that we can affect a really large jump in your credit score just by paying down some of those smaller limits and smaller balance debts. Take a minute to talk about the second part of the STEP process in obtaining a mortgage, and that would be the total investment. And in our mortgage lending environment, there are so many great, neat things out there and programs that can allow people to own a home with minimal investments. In some of our rural subdivisions, we have a USDA program that makes access to most people for absolutely zero down. VA is zero down, and FHA is available to anyone at 3.5% down. But one of the things when we talk about these programs that makes us a little bit unique is that we do pay your closing cost, and we pay up to 2% of the sale price in closing costs. So many times this will cover the entire closing cost. So zero down can mean zero down, or 3.5% down can mean only 3.5% down. So this gives people an opportunity to own a home with a minimal investment. The third part of the STEP acronym would be the E, or the employment. And talk a little bit about that for a minute, and some of the misconceptions that people have about employment, and would like make sure that everybody is clear on that. Many times with a lot of the programs that are available, a lot of people have kind of heard that they needed to be on their job for 2 years and they can't have changed jobs and things like this. This is not necessarily true. In regard to employment, one of the main factors is that you haven't been employed in the same field for that period of time. And there are a lot of exceptions to this as well. As far as having been a student, having taken time off to have children, there are several things that apply to this. So really, you want to get clarification on the employment issue. Don't assume that you don't qualify because of an employment issue, because of something that you heard. You need to talk to a credible lender. We can direct you to one of our preferred lenders. We can also give you what our opinion is. So again, don't take that for granted. The fourth part of the STEP acronym would be the P, or payment affordability. And one of the things that I kind of wanted to address, or take an opportunity to address, is some of the misconceptions and some of the kind of rules of thumbs that people have developed over the years. One of those being, and I hear this a lot from clients and customers, is kind of the 1% rule. And typically, and this used to be fairly accurate. In today's environment of historically low mortgage rates, it can be not anywhere close to accurate. But that used to be the 1% rule, and that would be that your payment was typically about 1% of the sale price of the house. And especially in working with our programs, and as I talked about earlier in the Sum of the Parts program, if you've looked at that video, where I explain how we break it down and we provide you with, we optimize the insurance, we optimize the interest rate, we optimize all these things. These are the kind of things that we sit down and we look at, and we have to kind of calculate on a case-by-case basis. But the old acronym of 1% doesn't really apply anymore. Most of our customers are amazed to find out how much home they can afford and what their payment dollar will buy now. These are unique times that we're in, and typically I've been doing this for over 20 years and built over 2,000 homes, and never before in the history of my career, or in my father in the past 50 years before me, have we ever seen a time, typically when interest rates drop, the cost to construct things goes up, and they usually go up in unison, or the cost to construct actually goes up faster than the dropping interest rates. We have seen a time here in the past few years, and it appears we'll continue to see for the next year or two anyway, a time where we have stable costs and low interest rate. And it is making the affordability index of owning a home or a new home lower than it's ever been in history. And this is a number that is actually tracked by FHA and in several different entities in different formats, and one of them called the Affordability Index. It's an interesting thing to watch, and it is the lowest that it has ever been on record. So, is it a good time? We certainly think so. The other thing that we also think is nature hates a vacuum, and when things typically swing one direction, they'll swing the other. And so right now we're enjoying the opportunity to provide really affordable new homes for our clients.